Chapter 13, Investment Analysis. Video 3, Cash Flow Statement and Valuation Ratio. In this video, we'll discuss cash flow and how valuation ratios are used to determine a company's financial health. Our third financial statement is the statement of cash flow. This financial statement shows how well a company can manage and pay its bills by measuring inflows and outflows of cash. Cash flow from operations consists of inflows from sales and services and outflows to suppliers and employee salaries. Cash flow from investments comes from gains, dividends, and losses on corporate investments. Cash flow from financing consists of raising capital from stock and bond issuance, and the outflows are loan payments and dividend and interest payments. The total money flowing in and out of a corporation is its cash flow. Cash flow equals the net income plus annual depreciation. Fundamental analysts use ratio analysis to gather information on liquidity, solvency, debt, and profitability. Earnings per share, or EPS, measures the company's profit on a per-share basis. To calculate the EPS, the formula is earnings available for common divided by the common shares outstanding. To figure out the earnings available for common, you take the net income and subtract the amount paid for preferred dividends. Once the preferred shareholders are paid their dividends, the amount remaining is the earnings available for the common shareholders. The diluted earnings factor the effect that convertible securities have on earnings if they're exercised. This includes any convertible securities, stock options, and warrants. The diluted earnings per share always create a lower EPS unless the company does not have any outstanding convertibles. Additional ratios measure earnings per common share and the portion of earnings paid as a dividend to shareholders. Notice that following the income statement is a smaller financial statement that shows the charges to the company's retained earnings for the year. These are the earnings that the company has not distributed to shareholders as a dividend, and they're shown on the company's balance sheet. On that balance sheet, you'll also see how many outstanding shares PLM Corporation has. In this example, PLM Corporation has 1 million outstanding shares of common. From the statements, we see that net income after tax was $3,100. But don't forget, these numbers are in thousands, so that's really $3,100,000. We also see that preferred shareholders were paid a dividend of $100,000. This indicates that the true earnings available for common were only $3 million. We know from the balance sheet that there are 1 million common shares outstanding. 3 million divided by 1 million equals $3 per share. The second ratio measures the portion of earnings for common paid out to common shareholders as a dividend. The dividend payout ratio is common dividends paid divided by earnings for common. In our example, common dividends paid $500. Don't forget to add the 3 zeros, so we have $500,000 divided by the earnings available from common, which we just figured out was $3 million. So of its earnings available for common, PLM Corporation paid out 16.6% as a common dividend, retaining 83.4% for use in the business. With the dividend payout ratio, if it's a low ratio, it's a growth company, and a high ratio would be a mature company. This example indicates a growth company. The next valuation ratio is the price-earnings multiple, or PE ratio. The PE ratio measures the stock price and compares it to the earnings per share. This ratio is calculated by dividing the stock price by the earnings per share. The dividends per share formula is total dividends paid divided by common shares outstanding. If this ratio increases each year, the company has sustained earnings growth. The dividend payout ratio shows how much of the company's earnings are paid out to the common shareholders. A higher number indicates a mature company, and a lower number indicates a newer company. The current yield formula is annual dividend divided by current market price. This formula can be used for either a stock or a bond. Stock current yield is often called dividend yield, and it's important to remember that dividends may be paid quarterly. So the first step in calculating the dividend yield is to convert the dividend to the annual dividend. For example, if the stock paid a 25-cent quarterly dividend, the annual dividend is $1. It's so simple, but it's an easy mistake to make if you read a test question too quickly. The last valuation ratio is the price-to-book ratio. This is used to compare a common stock's market value to its book value, and it helps determine if the stock is undervalued or overvalued. A low ratio indicates the stock is undervalued, and a high ratio can mean it's overvalued. The formula is current market price divided by book value per share.